Hey everyone, happy Thursday, June 5th. It's a little bit before 10 a.m. on the West Coast, and it's time for another market update. Not a lot of movement on the tariff front, but we did hear this morning that President Trump and the President of China has spoken. Hopefully that leads to a deal. The markets and mortgage rates would, love a deal on that tariff thing. And then the other little thing that's been going on is that new debt bill that's been going through Congress. That seems to have run in some opposition. It looks like Elon, I know, is not a big fan. Senator Rand Paul, some of the other senators. That's a good development on our end because we didn't like that bill. That bill was going to add a lot to the deficit, would not be good for mortgage rates, and that's not something we want. So, but the big news going back to last Thursday, it sounds like Fed Chair Powell and President Trump did meet at the White House. Based on the statement released afterwards, it sounds like it was a pretty quick meeting and maybe not the warmest meeting, but it's good that there was some dialogue. This week, President Trump has continued his attacks on Fed Chair Powell. His nickname for him is Too Slow Powell. And in that regard, it's hard to disagree with President Trump. The Federal Reserve has a history of being too slow to react. The reason inflation got as high as it was is they were too slow to raise rates. And then now we're finding ourselves in the opposite position where they're probably going to take too long. I've already taken too long to cut rates, and we're probably going to, our economy's going to hurt because of it. They tend to, drive while looking in the rearview mirror, while we all would prefer that they drive our economy, looking forward, so they don't drive us off a cliff. So that was, it'll be interesting to see what happens there if the political pressure has any effect. But the data has also started to move in our favor. So hopefully between the two, maybe that will get Fed Chair Powell to move. So as far as the data goes, going back to last Friday, we got the new April PCE inflation report. And this is the Fed's favorite inflation report to look at, especially that core number, which takes out food and energy costs, because that's what they believe they can control with their policy. So as far as April's numbers, the headline came in at just 0.1 number. Year over year, we're at 2.1%, which is a really low number. Core was only at 0.1%. So, you take that core number and exploit it out, 12 months, that's only 1.2%. That's below that 2% number that they've been targeting, supposedly. Year over year, right now, we're at 2.5%. But then, the 6-month rate and the 3-month rate have also gotten better. So in the short term, it's gone down from, 4.2 3 months ago, it was at 4.2, then 3.5, now 2.7. So good to see we're making progress here because, again, Fed has two jobs: keep inflation down and jobs high. So, and it seems like they've been concentrating on the inflation stuff. So good to see the inflation coming down. And then what went into that core? So that core number at 0.12, half of that was from shelter. And like we've talked about before, there's a big lag in shelter data. If you look at Zillow, Apartment List, any of the real-time data, it's showing that shelter inflation a lot lower than these reports from the government are showing. So we know there's a lag there. We know that's going to get better, and that's not necessarily where it's at. And then the other part about it, healthcare here at 0.06 is the other half of it. And, the Fed can do whatever they want to raise. They can keep raising them as much as they want. They're probably going to have zero effect on healthcare. So that number is what it is. So again, that's, going into this, but it's really not something they're controlling with their policy. So, for them to say, hey, we're not going to cut rates because that's too high, it just doesn't make any sense. And then the third part that's, adding to this is motor vehicle services. And that's directly affected by rates. People's leases and rates are higher because the Fed rate's higher. So their policy right now is causing more inflation on that front. So you put all that together as 0.14, everything else, every other number they put in this core number is negative. It's at negative 0.2%. So not just slowing down, but deflationary. So it looks like, inflation, we're heading in the right direction. There's not a lot of good comparable numbers coming up where we know we're going to make a ton of progress, but at least if we can keep on this kind of path, that should hopefully, kind of give us a little bit more of a runway to convince the Fed, like, hey, time to cut rates. Next thing, first there was inflation. Now the second part of the Fed's job is jobs week, keeping employment strong. So we got the April JOLTS numbers. That's job openings. It's a little dated. This is April's numbers, and we're in June now. That came in at 7.391 million job openings. It was supposed to be about 7.1, 7.2, so more than expected, which is generally not good for us. But keep in mind that number, there's a lot of double counting. A lot of companies now post jobs online with the same job with multiple multiple postings that get picked up on this, things like that. And then there's another part of this JOLTS report called the quits rate. The quits rate dropped to 2.1%. The quits rate is, what it sounds like is how often people are quitting their jobs. People tend to quit their jobs when they're confident they can get a better job. So the fact that the quits rate is dropping means that people do not feel confident they can quit their current job and go get a different job or a better job or whatever. So that is not the strongest indication of a labor market that's just great for employees. So that's, a good thing in our favor. There's some mixed data there with that headline number, but that kind of offset a little bit. So that was good to see. And then the one we got yesterday, which was a great number for us, was the May ADP. So ADP is private payroll. That came in only at 37,000 jobs created in May. That was supposed to be about 115,000. They also made a little small negative revision to April from 62,000 to 60,000. So this was a really low number. Markets rallied to this. We liked seeing this, maybe not the stock market, but, mortgage rates love seeing this because, again, we want the Fed to cut rates. The Fed will cut rates when inflation's down and job numbers start to look worse. And this is something making the job market look worse. So this was good for us. The big one is tomorrow when we get the BLS jobs report, but hopefully this means that we're going to get a low number there too. Next thing, initial jobless claims. So again, what we want is weakness in the job market, and this showed some weakness. It was estimated about 236,000 new unemployment claims, came at 247,000. So this is ticking up, and it was kind of in that 220 range for quite a while. So again, the more people lose their jobs, which I don't, not like I'm rooting for that, but in order for the Fed, the way our current system works with this stuff is we need the Fed to cut their rates, and they're not going to do it unless they see the job market's weakening and inflation slowing down. So this was a good one for us today. Where does that leave us? So the average 30-year as of today for a top-end borrower putting 40% down, dropped from last week 6.97 to 6.87 today. So again, still way too high, but good to get away from that 7. And good to see it head in the right direction. We've just been in this, 6.75 to 7 range for quite a bit now. So it'd be nice to see us break through that, 6.5 barrier and make our way down to that 6 number. And, maybe, please in the future, we can get a 5 in front of it. But again, good to see at least we backed off that 7 number because we had ticked back over that again a couple weeks ago. So where does that leave us as far as important dates coming up? Like I mentioned, tomorrow we're getting the BLS jobs report. Right now they're expecting 130,000 jobs or so created. Based off that ADP number being lower, maybe we'll get a lower number there, and that would be great. I'm sure the markets will rally that. Unemployment is supposed to stay where it's at, but any sort of tick up in that number would be good for us. And again, don't want to root for people to lose their jobs, but the way the system works, that's what we're going to need, it seems like, for the Fed to move. And we want them to move. We need them to cut rates so they're not too slow, or at least not as slow as they possibly could be if they keep waiting. The European Bank, I think, is about to do their 9th straight meeting with a cut, where we haven't done one in a couple of years now. So anything we can get to get the Fed to change their mind and say, hey, let's cut rates is what we want. Next thing after that, we get CPI next week, inflation. And then the Fed meets on June 18th. So 2 weeks from yesterday, we'll get the announcement on what their next decision is. Right now, the markets are expecting they're not going to do anything. But really what we want to do is clear the runway for the meeting after that, probably some point in August, to cut rates. If inflation data keeps coming in lower, if job market keeps showing weakness, and we get some of this political tariff and debt ceiling and all this kind of drama out of our way, and so the Fed can just concentrate on the data, which seems to be trending in our favor, that would all be great. And hopefully that would lead to a rate cut, which I know we're all hoping for across the markets, because that would lead to more activity. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, guys. Thanks a lot.